Hello, everyone. Thank you for joining us today as we discuss US tax and investing considerations for Americans living in Portugal in 2026. Before we dive in, a brief disclaimer. Please note that the webinar is for informational purposes only and it is not intended to offer advice or guidance on legal, tax, or investment matters. Such advice can only be given with a full understanding of each individual's specific situation. That being said, let's meet our panel. Michelle McKeehan is a greenback expat tax senior accountant and an IRS enrolled agent with Big Four experience. After starting her career in corporate finance, she pursued a master's in accounting to focus on individual taxation. She found her niche in expat tax, serving Americans abroad. Originally from New York City, Michelle has lived in Argentina, Switzerland, and now Portugal. Outside of work, she enjoys rock climbing, trail running, and riding her motorbike. Shane Clark is president and co-founder of EuroAmerican Financial Advisors. Shane specializes in financial planning and investment management for Americans moving to and living in Europe. With over 10 years of experience in international financial markets, Shane designs balanced and diversified global portfolios for long-term returns. Originally from Detroit, Shane has been an expat himself for over 10 years and currently lives in Sevilla, Spain. He holds the European Financial Planner designation as well as an MPhil in economics from the University of Strathclyde in Scotland. So without further ado, over to you, Michelle.
Hello, everybody, and welcome to U.S. Tax Essentials for Americans Abroad. My name is Michelle McKeehan. I am an IRS enrolled agent and an expat tax preparer for Greenback Expat Tax Services. We're a firm that specializes in U.S. tax returns and U.S. tax consulting for Americans who live abroad. Just a few quick notes about me. I am an American citizen and an expat myself. I currently live in Portugal, and before that I lived in Switzerland and I lived in Argentina. So I've been abroad for many years now, and I've been preparing expat returns for Americans outside of the US for over 10 years. So let's get started. Today, we are going to talk about US tax return reporting requirements for expats. We will talk about double tax relief that's available, FBAR and FATCA foreign asset reporting, some important considerations when you're investing as a new expat or an expat who's been abroad for a long time. And at the end, we'll end with some local tax discussions for your country. So let's jump in. Who needs to file a US tax return? The answer is US citizens and US green card holders who receive income from any worldwide source. This applies even if you are a dual citizen of the US and another country, and if you are a person who used to have a green card and simply let it expire. So your US tax filing requirement continues even if your green card just expires. It continues until you formally abandon your green card. So even though you might not have the legal benefits anymore, you still have the tax obligations. Congratulations. So what income needs to be reported on the US return? The answer is everything, all worldwide income. Sometimes people think that when they're a US citizen living abroad, they don't need to file a US return anymore, or if they do need to file a US return, only US income needs to go on that return. So maybe, for example, if they have a local employment in France and they have a rental property back in the US, maybe they're renting out their former main residence in the US. They're going to file a US return reporting the rental property, and they're going to file a French return reporting their employment income. That's not the case. If you're a citizen or a green card holder, you're going to report your worldwide income on your US return. And that's true even if your income is paid into a non-US bank account, even if there's a tax treaty between the US and your country of residence, even if you never stepped foot in the US for any reason at any point during the year and haven't been there for the last 15, 20 years, even if your income is already being taxed by a foreign country, whether that's through pay withholding or you're paying a balance due with the tax return to a foreign country. And even if you have a non-US employer, if you're self-employed, if you're working for a non-US company, if you never visit the US for any purpose, do any work in the US, you still have to file a US return reporting all of your income from any source anywhere in the world. So at this point in the conversation, people start getting a little worried and they think, okay, I'm reporting my worldwide income on my US return. I'm reporting my worldwide income on my residence return. My tax rate is going to be like 90%. Don't worry, the IRS has already thought about this. So there are two methods to alleviate double taxation that are written into the IRS tax code. So these aren't dependent on whether your country has a tax treaty with the US. They are available to everybody. The two methods are called the foreign earned income exclusion and foreign tax credits. And we're going to talk about each of those right now. So first up, foreign tax credits. How foreign tax credits work is your worldwide income is reported on your US tax return, and we calculate the US tax liability on that income. Against that US tax liability, you can claim a credit for any income taxes that have been paid to a foreign country. This only works for income taxes, not any other types of taxes you could be paying: social taxes, wealth taxes, church taxes, dog taxes. Only taxes on income are available as a credit. There are no qualifying tests you have to pass in order to claim foreign tax credits. You don't need to spend a certain amount of time outside of the US or anything like that. Really, the only requirement is that the income tax is due, meaning you can't simply make a payment to Italy of $10,000 and then pick that up as a credit on your return. If Italy says, you don't live here, you don't have any income from here, you don't owe us any money, here's your $10,000 back. If you prepay an amount to your foreign country, let's say you're self-employed and you make a payment of $6,000 to Germany, your German tax assessment comes in, you only owed $2,000, they're giving you a $4,000 refund. In that scenario, you can only pick up the $2,000 as a credit on your US return. Foreign tax credits work for both earned and passive income. So earned income is income that you provide services for. For example, employment income, self-employment income. And passive income is income that kind of makes itself. So bank interest, dividends, stock gains, cryptocurrency. If you rent out a rental property, a real estate property for income, something like that. Those are all examples of passive income, and foreign tax credits work for both earned and passive income. On the other hand, we have the foreign earned income exclusion, and this works a little bit differently than foreign tax credits. So how this works is, once again, your worldwide income is reported on the US return. And then beneath that, you get a little minus sign for your foreign earned income exclusion. The maximum exclusion is adjusted annually for inflation. It's currently around $130,000. And this allows you to exclude earned income. So again, only employment income or self-employment income. And the threshold is per taxpayer. So let's say you file jointly with your spouse, you both work abroad. Let's say you make $20,000 and your spouse makes $200,000. You can't give your extra unused exclusion over to your spouse. It's a per individual threshold. And very importantly, you still have to file a tax return and report your worldwide income. So I hear this a lot from clients that have been abroad for many years and not filing returns and need to get caught up with compliance, that they say, I was earning under the foreign earned income exclusion each year. I was only earning 50, 60K. I thought I didn't have to file a return every year. You have to file the return every year. You have to report the income and you have to claim the exclusion. The exclusion is reported on Form 2555, and on that form, you have to state how you qualify and compute your foreign source income and calculate your maximum exclusion. So this all needs to be filed as part of your return. You don't just get automatic access to the exclusion. So there's two tests in order to qualify for the exclusion. The first is the physical presence test, and the second is bona fide residence, and they're a little bit different. You just have to pass one in order to be eligible for the exclusion. So the physical presence test looks at where you were physically present during 330 days in a 365-day period. It doesn't need to be a calendar year, but it can be a calendar year. And what they're looking at here is whether your tax home was outside of the United States. Tax home is a special IRS term that does not mean where you are paying taxes. So it is possible to have your tax home outside of the US, even though you're not paying foreign income taxes or you're not paying income taxes to your country of residence. Tax home, the IRS says, basically just means where are you mainly working. If you're working outside of the US for 330 days in the 365-day period, you're eligible for the physical presence test. Bona fide residence is a little bit different. They're looking at a full calendar year period, so January 1 to December 31, and were you living outside of the US during that entire period? With this test, it doesn't matter so much how often you're going back to the US. So if you have to spend a little bit more time in the US, maybe you're caring for family, maybe you're sent back for work a lot, then you don't have to track your days so much with bona fide residence. They do ask for more information from you about your visa, where your home is, where your family is living. All of that is reported on Form 2555. If you pass one of these tests or both and you claim the foreign earned income exclusion, you can only exclude earned income. So only income from employment or self-employment, cannot exclude interest, dividends, capital gains, cryptocurrency, rental properties, anything like that. Only earned income. And something very important about the exclusion, this is a binding election. Once you elect the foreign earned income exclusion, you must claim this election every year. It is possible to revoke the exclusion, but once you revoke it, you cannot elect the exclusion again for 5 tax years. So it's more serious to claim the foreign earned income exclusion than foreign tax credits on your return. And especially in the first year, you want to be pretty sure about what you're doing when you're choosing between the exclusion and foreign tax credits, you want to have some idea of what's going to be best for you, not only in your first year, but going forward for many years. So let's talk about that. Which method is better, foreign earned income exclusion or foreign tax credits? Of course, it depends on your situation, but we have some general guidelines here. So if your foreign income tax rate is lower than your US tax rate and or your foreign earned income is under the threshold, generally, foreign earned income exclusion is a great idea. It makes it really simple to just sort of report your worldwide income on your US return, have that little minus sign, zero everything out, file the return, done. If you don't have a lot of other sources of income, like passive income, things like that, this is a great, easy way to not have to wait for a foreign return. If your foreign return is problematic, so sometimes we see certain foreign countries that maybe are not in a rush to finalize your resident return, and the filing deadline is well after the US return. You want to get everything filed in the US. You don't want to be late. You don't want to deal with the IRS sending you notices. You don't want to worry about it. If you don't want to deal with waiting for your foreign tax return to be done in order to pick up foreign tax credits, maybe the exclusion is a good way to just file a simple US return and not have to worry about it. When are foreign tax credits ideal? If your foreign tax rate is higher than your US rate, that makes it a really easy situation to just zero out your US tax liability and have nothing to do with your US return. If you have passive income, so interest, dividends, things like that, you can't use the income exclusion with that type of income. So if you have significant passive income and you're paying income taxes to your foreign country on that income, you probably want to be picking up foreign tax credits on your US return so you're not double paying. If you're moving around a lot, foreign tax credits may be a better idea because if you're moving between jurisdictions that have higher or lower tax rates than the US, you don't want to be stuck with the exclusion since it is a binding election. Maybe you want more flexibility to claim foreign tax credits if you end up moving, if you work for many years in a country that has a higher tax rate than the US, and then you move to a country that has a lower tax rate, you can draw on previous accumulated credits in order to make up for the difference. And then later you move back to a country with a higher tax rate than the US. It gives you more flexibility with foreign tax credits to sort of drop from your balance and not be stuck with a binding election that doesn't work for you or have to revoke it so that it may work again in a future year. If you're traveling back to the US a lot for work, that's another situation in which maybe you don't want to be stuck with the earned income exclusion because the exclusion only works with income that's earned while you're present outside of the US. So let's say you have a Ethiopian employer and Ethiopia is taxing your employment income, and Ethiopia, your company, sends you to the US to work for 2 months. You can't exclude the portion of your prorated salary that you earned in those 2 months on your US return. Even if Ethiopia is taxing it, maybe they're not going to say, okay, you worked those 2 months in the US, we're not going to tax that income. They're going to tax your entire income. So in that situation, foreign tax credits are probably better. If you have a lot of US presence, whether for just traveling or working, foreign tax credits may be a better idea. It's also possible to claim both the exclusion and foreign tax credits, but you can't double dip, meaning you can't claim credits on income which has been excluded. But it's definitely possible. Let's say you weren't over the foreign earned income exclusion threshold. You can claim the exclusion, $130,000. For your income after that, you can claim foreign tax credits on that remainder. Or you can claim the earned income exclusion on your earned income. And if you have some passive income, if you have some bank interest or something that the UK is taxing, you can pick up that UK tax credit only on your interest income. So now that we know who needs to file and what they need to file, let's talk about when the return is due. April 15th is the standard deadline for everybody. All taxpayers apply for this deadline. If you are outside of the US on April 15th, you get an automatic 2-month extension. And we're looking here at where you are living on April 15th. So let's say you were abroad for the entire 2025 tax year, but you moved back to the US on February 9th, 2026. You're not going to be eligible for this extended deadline. You're back in the US on April 15th. The regular deadline applies to you. Only if your tax home is outside of the US on April 15th can you get the automatic extension. And it is automatic. You don't need to apply. You don't need to file anything. It's automatically granted. All taxpayers, whether they're April 15th or June 15th filers, can file Form 4868 to get an October extension. So you get 6 additional months in order to file your return, but not to pay any tax due. And then finally, once again, if your tax home is outside of the US on October 15th, you can request an additional 2-month extension by filing a letter with the IRS. There's not a particular form or template. You just have to say in the letter, I'm an expat, I need a little bit more time. You won't hear anything back, and if you don't hear anything back, it means the extension was granted. What about US state tax returns? This is a topic I talk a lot about with clients who are newly moving abroad. There's some misconception that because this federal requirement exists that you have to keep filing US federal returns as a citizen, that the state requirement exists as well. And people think they have to keep filing a state return when they're abroad, even though they're not necessarily state residents or earning anything from within that state. That is not the case. The requirement to file is only a federal requirement. You only need to file a US state return if you are living in that state or if you have income from that state. So if you're living in the state, you'll have a state resident return. If you are non-resident of that state, but you have income, so maybe a rental property within that state, something like that, then you'll be filing a non-resident return. But people ask me a lot, hey, do I need to find a friend in Florida or get a Florida driver's license, or do I need to set up a mailing address in Texas or something like that? You don't necessarily need to create a false state residency in order to terminate your state residency. States vary on when they will consider you to have broken residency, as we say. But generally, if you leave that state and you don't have a lot of continuing ties, meaning you don't have a property that you leave abandoned for your use, or sorry, empty for your use whenever you go back, if you're not returning, I don't know, very frequently in order to work from that state, if your wife and your kids didn't stay in that state while you're working from Europe, if you basically don't have a lot of ties left to a certain state, you're probably not going to be filing a state return, and you don't need to take any drastic measures like establishing a false residency, so you don't need to file state taxes every year. So let's talk a little bit about the FBAR. The FBAR is an information return, meaning no tax is due, that reports the highest balances in non-US financial assets. So what does this mean? This means that if the cumulative highest balances across all your non-US accounts exceed $10,000, you need to file this information return reporting those balances to the government. The threshold here, people sometimes think it's per account, so they only need to report individual accounts whose highest balance went over 10K during the year, but that's not the case. We're looking at the highest balance each account reached during the year and then adding all of those up. And if you exceed 10K, then you need to file an FBAR and report all of your accounts. So if you have 11 bank accounts that each had $1,000 in them, you have to file an FBAR and you have to report all of those accounts. Financial accounts that you need to report include bank accounts, savings accounts, checking accounts, paycheck accounts, things like that, as well as investment funds. Private pensions are also reportable on the FBAR. And the FBAR is separate from your tax return. It is not, it's a completely separate filing with separate deadlines. It's filed with a separate tax authority. People sometimes ask me or tell me rather that they don't need to file an FBAR because their bank does that for them. Your bank does not file FBARs for you. Your bank will provide information about your account to the US when asked. That is not the same as filing an information return for you each year. Your information return reports all of your non-US accounts. So that could mean accounts that one bank doesn't know about. There's no way for them to file an FBAR for you. They're not doing it. It's your responsibility and your responsibility alone to file your FBAR each year. When is the FBAR due? There is a standard deadline of April 15th, and everybody has an automatic 6-month extension until October 15th. You don't need to file anything. You don't need to have a federal extension in place. All taxpayers are eligible, so essentially the FBAR is due October 15th. Next, we have FATCA. FATCA is extremely similar in principle to the FBAR. So we are reporting the highest balances of non-US financial assets, exactly the same assets as with the FBAR, checking accounts, savings accounts, investment accounts, pensions, things like that. The differences are that the filing thresholds are much higher, and they're based on your filing status and your residence. So these thresholds that we have listed here are for expats. And if you're single, your assets, your combined highest value across all of your assets, $20,000 on December 31 or $300,000 at any point during the year. If you're married and filing jointly, not if you're just married and filing a separate return. So if you're married and filing jointly, the thresholds are $400,000 on the last day, $600,000 at any time. FATCA is reported on Form 8938, which is part of your tax return. And once you hit these higher thresholds and need to file Forms 8938, you still have to keep filing FBARs. It's not one or the other. If you're filing Forms 8938, you definitely have to be filing FBARs as well. So let's talk about some investment considerations for expats. So one really important one that I see is currency fluctuations. When you're investing in currency other than US dollars, remember that everything will be converted to US dollars on your US return. We're going to be looking at and using the spot rate for that day for whatever currency you're transacting in. And so it is possible if currencies are fluctuating a lot that you have a situation where you have a loss for your residence country purposes. So let's say you purchased an asset in 1996, you sold it in the year 2000, I don't know, the year 2020, and you have a loss in the Netherlands. That loss will go on your return, will offset your income, it's a tax benefit. However, when we convert everything into US dollars, you actually end up with a gain. So you're reporting a gain on your US return and a loss on your Dutch return. This is completely possible. It's very upsetting to taxpayers when this happens. Just something to keep in mind. When you're investing in a currency other than US dollars, ultimately that investment is going to be reported in US dollars on your US return. PFIC reporting is a huge deal in the US. Basically, what's going on with PFICs is that the IRS has passed, it's written into the tax code that US persons should be investing in the US. And what happens when we have PFICs is that sometimes, so what is a PFIC? It's something like a foreign mutual fund, some type of pooled investment that takes place outside of the US. These are always non-US investments. Usually these are billed as pensions accounts or savings accounts, something that's going to give you a nice tax benefit every year with your foreign country return. But on the US, it's the opposite. It's cash drain. What's going to happen is that the US is going to tax the unrealized, undistributed gains in that account every single year. So you're going to be paying out-of-pocket tax on income which you haven't received and might never receive. In addition to that, you have to file the PFIC forms 8621, which are extremely complicated. Tax preparers charge very high fees for filling out these forms because they are so complicated, and there are really high penalties if you get something wrong on this form. Generally, stay away from PFICs. If you're making an investment, ask your advisor, the financial institution, if it is a PFIC. If they say they don't know, run away, find another advisor. Another option is just to invest directly in stocks in the US. to avoid any of these types of pooled investments that could be considered PFICs. Non-US pensions, sort of similar to PFICs in a way that people sort of think, okay, great, my employer set up this account for me. I'm not getting any distributions. Maybe my employer is putting something in. Maybe something automatically comes out of my paycheck. I'm not thinking about it. I certainly don't consider it income. Unfortunately, non-US pension, the contributions, earnings, and balances need annual US reporting, even if you're not taking distributions yet. So generally, your contributions, your employer's contributions, and whatever increases in the account have occurred, so interest, something like that, these all need to be reported as income on your return, and non-US pensions are reportable on FATCA and FBAR. So people are often not thinking of that when they say, oh, I don't have an FBAR filing requirement. If they're in a country like the UK, I'll always ask, okay, how much is in your pension? That's usually what will kick you over that threshold pretty easily. So let's talk about some specifics for US expats living in Portugal. When you are living in Portugal, generally this is one of the countries we see where foreign tax credits are a better option because the tax rates are generally higher than the US tax rates. Portugal has 3 applicable tax rates. So there is a tax on residents, and they pay tax at progressive rates. Non-residents pay tax at a flat rate, and then they have this non-habitual regime in which you're paying Portuguese tax at flat rates. Whether you are a resident or non-resident in Portugal, as long as you are paying income tax to Portugal, those can be picked up as credits on your US return. There is an income tax treaty between the US and Portugal. People often think the income tax treaty is going to help them out a lot more than it actually does. And that's because in the treaty, as with all tax treaties with the US, there is a savings clause, which basically says none of this applies to US citizens. Maybe 1 or 2 provisions are exempt from the savings clause. I mean, you can actually use them. And in most cases, the clauses that we're using are helpful for retirees. So we're looking to the treaty for how both countries will treat Social Security income and private pension income. So according to the US-Portugal Treaty, if you're receiving US Social Security benefits, so if you're receiving US Social Security distributions, those are going to be taxed in the US, and Portugal will grant you a foreign tax credit for the tax that you're paying to the US, which is a reverse of our usual scenario, which is that your foreign country, Portugal, is taxing your income, and we pick up that income tax as a credit on your US return. So this is one type of income in which everything is a little bit reversed. If you have a US private pension, like an IRA, something like that, and you take distributions, that will only be taxed in Portugal. It will be exempt from tax in the US. It needs to be reported on your US return. There's a section where you write the amount of distributions, and then there's a little line next to it that says taxable amount, and that will be 0. And you can include a note that under the treaty, this is taxable only in Portugal. In addition to an income tax treaty, there is a Social Security totalization agreement between the US and Portugal. And this is going to be helpful in 2 different ways. The first is for self-employed individuals. When you're self-employed, you owe 2 types of tax on your income. First is income tax, which we've covered a lot in this presentation, but you also owe self-employment taxes, Social Security taxes. Under the Social Security totalization agreement, you only owe self-employment taxes to one country. So if you are living and working in Portugal and you're self-employed and you're paying Portuguese Social Security taxes, you will not owe self-employment tax to the US. And this is something that I see really commonly done wrong on clients who have been self-preparing their own returns for many years who come to me. And they say, like, yeah, I'm paying such high tax rates, but I always have this balance due with my US return. And I'm like, interesting. Let's look and see why that is. It's often because of self-employment tax. If you're using a software like TurboTax or one of those that automatically basically calculates your return for you and you're not really understanding exactly what's going on, they're not going to know that you live in a country with a Social Security totalization agreement that makes you not owe US SECA self-employment taxes. Something that you kind of have to manually override and make sure that you're not paying that balance due with your US return each year. The second benefit of the Social Security totalization agreement is for individuals who maybe had a little bit of work credits in the US and a little bit of work credits in Portugal, but not enough to qualify for Social Security benefits under either country's laws. Because there's this agreement, the countries will combine your work credits so that you meet the threshold and you're able to receive benefits. So that's huge, as opposed to working, maybe if you're a digital nomad, something like that, maybe if you're working in a bunch of different countries, make sure you're working in treaty countries with a Social Security treaty, so that all your credits will be combined and you'll be eligible for benefits when you retire.
Thanks very much, Michelle. Next, over to Shane.
Thank you for joining us tonight. Thank you for the introduction, Hugo. My name is Shane Clark. I'm the president of EuroAmerican Financial Advisors, and we are a cross-border investment advisory firm. We're headquartered in Sevilla, Spain, and licensed with the Spanish investment authorities as an independent investment advisor. We also have a sister firm in San Francisco, California, called International Asset Management. That's been around for 25 years. It's a fiduciary. And between the two firms, what we do is we focus on putting together an investment portfolio for you that is tax optimized and compliant in both jurisdictions. So without further ado, let me share my screen and we can get started. There we go. Can everybody see that okay? All right, so what I wanted to discuss is kind of a brief overview of why is this so complicated being a US expat living abroad? And then some cross-border financial planning considerations. What is financial planning across borders? A common question we often get asked is, my broker no longer works with me. What are my options? Do I stay custodying my assets in the US? Do I move all my assets abroad? These are some things we're going to touch on. How to manage currency risk and how to move money between currencies efficiently. We'll talk a little bit about some portfolio considerations, things to look out for, things to avoid. Buying real estate, this is important. Do you see real estate as an investment or do you see it as a passion project? So that's something to distinguish between. Briefly, I want to discuss what happened in the market in 2025 and what we expect to happen in 2026. And then I'll discuss a little bit about working with us versus some of our competitors. And then lastly, a short checklist. So one question I often get asked, should I invest in local tax efficient funds? The answer is no. The reason why is these local tax efficient funds are usually only tax efficient in your country of residence. So then when you file your US tax return, it's going to create a big problem for you. And really the secret in cross-border investing is being compliant in both jurisdictions and efficient in both jurisdictions. You could think of it like taking medication. If you take one pill to solve one problem and another pill to solve another problem, but the interaction creates a bigger problem, that's what we're trying to avoid. So the answer is no, because usually these are called passive foreign investment corporations, foreign mutual funds, foreign exchange traded funds. And Michelle will talk about that as well. So why is this so complicated? Well, here's a brief overview. As you know, in the US, we're a little bit different than other countries. So we have what's called citizenship-based taxation. Most countries have residency-based taxation. The difference is wherever you live in the world, you're always going to have to file a US tax return. Whereas most other expats, maybe you have some friends from the UK, they have residency-based taxation. So they only pay and file, generally speaking, in their country of residency. The next one is FATCA, the Foreign Account Tax Compliance Act. This, when you open a new bank account abroad or a new investment account, you have to fill out additional forms because you're a US citizen. And this is why. But it's also a reason why many foreign institutions don't want to work with US people. It's too much of a compliance burden for them for such a small amount of their business. The next one is FBAR. It's a tax reporting form. There's two different versions. One, if you have more than 10,000 US dollars in any accounts overseas at any time during the year, you have to file an FBAR. And then there's another one if you have a larger amount. PFICs, we talked a little bit about that already. Passive foreign investment corporations, foreign mutual funds, foreign pension plans, often foreign exchange traded funds. These can often be in alternative investment funds, private equity, all things to look out for before you buy them. Ask your US tax advisor. And then MiFID is Markets in Financial Instruments Directive. Now, this is what governs our institution in terms of legislation. So there's MiFID 1, MiFID 2, MiFID 3 should be coming out this year. And it's about how we can operate in the EU as an investment provider and what protects you as a consumer. So coming from the US, you wouldn't work with a firm that's not licensed. If some guy pulled up in a van and said, hey, invest in my whatever project, you'd probably want to see his credentials. Well, it's the same thing over here. You don't want to work with a company that isn't licensed in the EU. So if you work with us, we are licensed in the EU. We're also licensed with the SEC in the US. So you have two sets of protections. The next one is PRIPS, Packaged Retail Investment and Insurance-Based Products. This is always a mouthful for me. But this one, you've probably found doing some research that you can't invest in US exchange-traded funds as a retail investor. So you open an account, try to buy ETFs, they tell you can't buy them. This is why. It's an EU legislation which states that any fund coming from the US needs to provide a key information document. US exchange traded funds don't provide that document. And the reason they don't is because the Securities and Exchange Commission says they can't forecast performance. However, the KID asks to do that. So they can't do it. Now, there is a workaround, and I'll discuss that in a minute. So what is cross-border financial planning? Well, what we do is pretty similar to what you would have done in the US if you're familiar with financial planning. And then we incorporate the additional cross-border elements. So there's a new tax regime to take into account, a new currency to take into account, new laws to take into account. We put that into our software and we come up with a plan. So what we do is we prepare 3 personalized financial statements, a balance sheet looking at your total assets, an income statement looking at how much money's coming in versus your expenses, and then a statement of cash flow. We incorporate any goals you have. Maybe you want to buy a beach house. Maybe you want to get an apartment in Rome. Maybe you want to fund your grandkids' education, whatever that might be. We incorporate those goals and we project everything into the future. And then at the end, our software gives us a probability of success. So a common one is, do I rent or do I buy? Well, coming from the US, it's pretty common to own your own home. However, when you move countries for the first time, it's a whole new country, a new language, new friends, new people. I recommend renting for a year, getting to know the new city, what part you like. Maybe you make new friends and they're living on the other side of town. I think it's a good transition period and you don't want to tie up your assets. Buying and selling isn't the same over here as it is in the US. In most countries, there's a significant tax to buying a property. So that's what we recommend there. And then, I give France as an example, hidden costs of living in the EU. Well, each country has its own unique situation that it's important to consider and speak with a tax advisor on. Pension integration, how your Social Security or pension fits into your financial plan. We incorporate that as well. And then we also look at estate planning. We don't do estate planning in-house. We work with local attorneys who can help you with that, drafting documents, making sure that whatever you have in the US is going to be recognized. Here's the big one, custody. So you're leaving the US, you work with Wells Fargo as example. They tell you they can't work with you anymore because you're moving to the EU. This is really common. And the reason it comes as a surprise sometimes is you might tell your broker, I'm moving. He says, no problem. Then he enters your address after you actually move, boom, sends an email to their compliance team. And then the compliance team, they reject it. They say we can't work with people living abroad. So oftentimes your broker isn't going to know that answer. He's going to want to keep you as a client. You have a good relationship. Why wouldn't he? But then he finds out when he actually enters the new address. So what we do is we work with two custodians who have no problem with you being an expat. One is Charles Schwab. The other is Interactive Brokers. There's benefits to each of them. Schwab, remember earlier we talked about PRIPS? Schwab has a stance that if you're an institutional client, meaning that you work with a US-based registered investment advisor, they'll let us buy US exchange traded funds on your behalf. So it's a nice workaround. Interactive Brokers is interesting in that they operate all around the globe. So we can trade on any platform, any exchange, and we can hold multi-currency accounts. So for some clients, with our US firm, we can trade on the European exchanges and hold a pool of securities denominated directly in euros. And I think, a lot of times these days we hear people who have concerns about their money in the US. So they want to get their money outside of the US financial system. There's a lot of pitfalls with that. One is the cost. So what is the cost of custodying your assets outside the US? It's always much higher. People are very fee conscious. I understand that. And if you're fee conscious, that applies to what you pay your advisor, what you pay the platform, what you pay for products, what you pay for trading, these types of things. In the US, it's pretty common not to pay for trading for the most part anymore. If you custody in Switzerland, they might take 1% of the value of the trade every time they trade. So these types of things are really important to take a holistic view on. And then financial system diversification. With a taxable account and Interactive Brokers, it's actually custodied in Ireland. And that's a good option if you want to have money outside the US for one big reason. They produce US tax reporting forms. So you can delineate between long-term capital gains and ordinary income on your US taxes. Tax reporting, here we are. So that's what I was mentioning a minute ago. If you get audited by the IRS or you're not a tax resident in the EU, but you spend a significant amount of time here, so you need to have US tax reporting that is compliant for measuring long-term capital gains. And that is something that Interactive Brokers does, and most European banks and brokers do not do. Another one is safety. So in the US, we have very good SIPC insurance up to $500,000 per account. In the EU, it's much lower. Currency risk. So how do we manage currency risk? What is it? Well, I think we've all experienced it last year. So last year, the euro appreciated relative to the dollar around 13%. So that means that if all of your money was in US dollars, you lost around 13% of your purchasing power over here in Europe, which is significant, especially if you're on a fixed income. So that's something that we need to manage. How do we do it? We do it in two ways. One, the easy way, indirect currency management. So what we do is we trade with a Charles Schwab account buying US ETFs that hold European securities. Then those securities, the ETF, if the euro goes up 13%, the value of the ETF goes up 13%. That's indirect currency exposure. Direct currency exposure is what I mentioned with Interactive Brokers, where we go on the European exchanges, we buy a pool of European stocks held in euros. So then you have your neutral currency risk if you're living in the Eurozone. So those are kind of the two options there. And then the other question is, how do you move money in an efficient way? So if you want to move $500,000 to buy a house, if you go to your bank, they're probably going to take around 3% of the total. Now, most people, when they convert currencies, they say they don't charge a fee. And that might be true. But how the rate that they give you, the spread, is how they make money. So if the spread is huge, the bank is going to take around 3% of the total. Now, if you use a currency broker like Spartan FX, Wise, MoneyCorp, you're going to have a dedicated person you can call up, explain your situation, give them your timeline, and then they can help you as an informed trader. And they're usually going to take around a quarter of 1% to half of 1%. So that's what we recommend doing, is using a currency broker if you're moving money. So some portfolio considerations. What is different about managing your portfolio as a cross-border investor versus just being in the US? Well, we already talked about currency risk, which is really important. Another one is how much geographic exposure do you want to the US versus the rest of the world? For example, how we manage the portfolios, we made a big change around 2 years ago. We used to have a lot more US exposure. We reduced that to around 50%. So now we're approximately 50% US geographic, 50% rest of the world. And I think that's important for mitigating risk. Another thing that we have in our accounts is gold. So gold is a natural hedge. If there's inflation, if there's excess volatility in the market, geopolitical events, concerns about the value of the US dollar, that's why we keep gold in the portfolio. It's done extremely well the past couple of years, and we think that it still has a pretty valid place going forward. And then lastly, I mentioned being tax efficient and compliant. So I could do a whole presentation on tax efficiency for how we manage the portfolio. In general, on the equity side, we tend to use individual stocks versus funds. It's more tax efficient. We can talk about that on a one-on-one later if you like. And then being compliant. So this is avoiding things that create a problem in either jurisdiction for you. So we don't want to buy PFICs, EU funds that are going to create a problem for you in the US, as an example. And this is surprisingly, it's very important and easy to get wrong. Okay, buying a house. So this is something I always find interesting, and I'm guilty of it as well. So when you look at an investment, if you're looking at buying IBM stock, no one really falls in love with IBM stock. You might like it, it pays a good dividend. You could take it or leave it. A beach house, that's a little bit more of a sexy investment. So we always say, let us help you with this. If you're buying real estate as an investment, you have to treat it like every other investment, meaning you have to look at what's the cost of capital, what's the yield, what do you expect in capital gains, all those types of things. So you can't let the decision become emotional. And then also for purchasing a property, moving money, we recommend, again, using the currency broker for that. It's complicated. Buying a property overseas, if you've never done it before, it can be overwhelming. And it can also be one of those things where once you start hearing, okay, I need to hire a lawyer, I need to hire a historian, I need to hire someone to do a technical evaluation, all these things start to add up in terms of costs. There's a big upfront tax. If you get it wrong, it's going to be much more expensive. So if you buy a property that no one paid taxes on for 30 years, or they didn't pay the community fees, or someone borrowed against it, all those types of things create a much bigger problem than if you do it right at the beginning. So we always recommend hire a team, hire experts who work with Americans buying property abroad and have experience in it. All right, real quick, kind of looking at the 2025 year in review. So it was a good year in the market across the board. Strong gains on the equity side, mostly led from tech. So there's a lot of AI companies right now which are doing quite well. They've had strong earnings growth. They've been, investing a lot in their own infrastructures as well as related companies. And you can see S&P 500 last year was up 16%, NASDAQ 20, the Dow was up 13, in the UK 21%, in the EU a little more than that. And if you account for the valuation appreciation of the euro, I think it was close to 36% relative to the dollar. So we saw a good year in the market across the board. Emerging markets did well. Typically when the dollar depreciates, emerging markets do better. And there was a lot of volatility, if you remember back to last spring. So there was a lot of, trade war, tariff, negotiations that caused a lot of short-term volatility. And we expect that to continue into 26. However, the reports that we've read expect 26 to be a good year in the markets as well. So we're going to continue to see some of the momentum in a lot of the sectors we've seen in 2025. There's also talk of deregulating the banking sector in the US. And this, there's short-term, medium-term, long-term consequences of deregulation. In banking, usually the short-term is good. So short-term deregulation, what I mean by good for the market. So we expect that to free up a lot of capital. There's going to be a lot more investment. Money's going to be cheaper. People can invest in their own companies more. Risks, we continue to see, AI cost inflation. There's a lot of money being spent on this. And there is some, distribution concerns as well, and valuation concerns. So a lot of these AI companies do have extremely high valuations. Now, something we often hear is this is just like the dot-com bubble. It's not. So the dot-com bubble was different in that those companies often didn't have any earnings. So they were pre-earnings companies with huge valuations. These companies have strong earnings growth. They have high valuations, probably too high, but they're continuing to grow from a revenue standpoint. And then also what's going to happen with interest rates. That's the big question. There's a lot going on right now in the Federal Reserve, which leads me to my next point, geopolitical uncertainty, trade policy. What happens with all of this is going to depend on intermittent volatility. So in summary, what do? We offer cross-border investment advice. We structure your investment portfolio in a way that optimizes your taxes locally and in the US, and we try to get the highest return we can for your given level of risk. My partner Tom and I, who founded this company, we've been doing this for a number of years ourselves. We're both expats. We've seen a lot from different client situations that we have some unique knowledge, and we can help your situation from that. And then we also do the financial planning in a cross-border conscious way. In terms of our qualifications, we are licensed in both jurisdictions. We're a fiduciary in the US, independent in the EU. I have the European Financial Planning designation. In the US, my partner has the CFP, Certified Financial Planner, as well as the CFA, Chartered Financial Analyst. So we both are qualified and have seen a lot. And then in terms of, the expat checklist. So whenever we have the initial call with folks, they often ask, is there anything I'm forgetting I should be asking, things I should know about? The answer is always yes. In a 30-minute call, we can't cover too much. But what we try to do before you move, we have a list of things to make sure that you check or speak with a partner to help you with just after you move, and then ongoing issues that we need to address, throughout the future. And then the next thing I want to talk about are some country-specific issues. So the next thing I want to talk about is what makes Portugal unique from a financial planning standpoint. So many of you, or probably all of you, have at least heard or are on NHR, the non-habitual resident tax regime. Now, NHR 1.0, which ended a couple of years ago, was great for US retired people or people just living in Portugal. NHR 2.0, it's not as great. There's not as many tax benefits there. But a question we often hear is, what do I do when NHR ends? That is the question. So what we typically do is we work with a local Portuguese tax advisor, a US tax advisor, and then all parties get together. We look at how your accounts are currently structured. We let the Portuguese tax advisor weigh in if we need to make some structural changes to optimize everything before you become a standard Portuguese tax resident. And then we also look at what we need to do in terms of your portfolio to optimize as well. Another issue with Portugal that is similar in other European countries, but important for estate planning purposes, is generally US trusts are not recognized and there's forced heirship laws in Portugal. So we always recommend having a conversation with a tax advisor in Portugal and an estate planning attorney to help make sure that everything is aligned correctly with your US estate plan. And then also, again, all parties probably need to get together and discuss that as well. Looking at local Portuguese retirement accounts, in the US, we have IRAs, 401ks, and those are typically in the joint tax treaty. In Portugal, they have products, PPRs, which some of you may be aware of, and these make sense for Portuguese people, but the problem there is if you're a US citizen filing taxes in the US, these tend to create problems for you in the US. So it's something that we often try to avoid. Another issue in Portugal specifically is coming off of NHR, how your income is treated from an IRA versus how it would be treated in the US. This is again something where we recommend speaking with a Portuguese tax advisor on. Alternatively, if you're just moving to Portugal and you're not on NHR. So I believe income, it's best to out of an IRA at all costs. It's going to be treated differently than if you took money out, paid the taxes on it in the US, and then lived off it as a long-term capital gain. So these are where the nuances of two different tax tables really need to be evaluated to see what makes the most sense for you and your situation.
Thanks very much to our panelists for those presentations and to all of you for joining us today. If you'd like to find out more or to discuss your situation, for US taxes for expats, go to greenbacktaxservices.com. For financial planning and investment management, go to EuroUSAFA.com. Thanks again, and I wish you a very pleasant rest of your day.